It's a story we seem to hear again and again. Another company is divesting from their Canadian oil sands assets, and of course, as every other time, they seem to be selling them to Canadian natural resources. In today's video, I'm going to be talking a little bit about Shell and CNRL, Canadian Natural Resources Limited. I might also call them CNQ because that's their ticker symbol. These are two very different giant Canadian companies that are giants in the Canadian energy space, and they're taking dramatically different directions. So I want to talk a little bit about that story because I think it's time we have a conversation about what we like and don't like from the strategies of these big Canadian companies in the context of 2025 and forwards. Welcome to Golden Arch Investing. My name is Liam. In today's video, we're going to be talking about specifically Shell and Canadian Natural, and we're going to be sort of introducing some of the ideas and the core concepts of each of those companies, what their strategies kind of look like, and of course, I'm going to give some of my opinions. If that kind of content interests you, you like talking about Canadian investing, please do subscribe to the channel and like the video. It makes a huge difference. I've got some notes on the screen here, and my first thing I want to talk to you guys about are strategic goals. So big picture things, what are they trying to do? I think Shell should be the one that I talk about first, mainly because they're the one that's sort of diverting from their past strategy. Obviously, they had some assets that they're getting rid of. They've got other assets that they're acquiring, and just in general, their Canadian sector makes up a smaller part of the overall conglomerate that is Shell. So I have them split into three main categories. This is obviously not a comprehensive look, and it's sort of some of the main core things they're planning. And the first thing I'm going to talk about is liquid natural gas expansion. And the big story here is LNG Canada. It's a project that we probably should be talking about on the channel because it's really a game changer in the Canadian energy space. Obviously, LNG, it's in Canada. We're talking West Coast Canadian LNG exporting. This is something that companies have been complaining about for a while. Obviously, we heard that there was not a business case to ship it to the Atlantic, but in the Pacific, on the West Coast of Canada, there has definitely been a business case. Lots of companies are very invested, and Shell specifically here has a 40% interest in that project. So it's critically important for Shell. There's also just a sort of bullish sentiment on LNG growth. All of the Canadian energy sectors have some serious volatility, but there seems to be a growing base of bullish companies, investors, and just bullish money looking to invest in this space because of the sort of inexpensive, I'll say not cheap, but inexpensive in contrast with some of their peers' ways that we extract natural gas. And of course, the geopolitical stability of Canada. We're in a position where we're very unlikely, I hope, to be in major conflicts the way that so many other natural gas producers are. Shell specifically, though, is careful about long-term volatility, and they have been locking in longer-term contracts to make sure they can just get through whatever happens in sort of the short term, because they have their sort of eye set on that long-term LNG bullishness. I think it's really bullish for natural gas investors in general, but Shell incredibly bullish on LNG. Next core focus for Shell is on the low carbon transition, and that's their wording. And really, this is just talking like so many companies are about the energy transition away from fossil fuels. But specifically, Shell's doing a couple interesting things. They're investing more into systems like the carbon capture project that they traded some of their oil sands assets for to CNRL. So they're looking at things like carbon capture, but also they're looking at public electric vehicle charging. They're investing in renewables. It looks like they're just focusing on how can they be a part of the energy transition. They do not want to get left behind, and they're putting that as a strategic objective. And the third core focus here is upstream efficiency. So they're working on reducing the carbon intensiveness of their production of oil and gas. So at the upstream, at the sort of producer level, they're looking at ways, okay, how can we make this more efficient when it comes to sort of the climate issues? So, you know, how are we powering the mine or the plant or the well? How are we transporting it? All of those sorts of things. They're trying to find ways to be more carbon efficient. So obviously, we're looking at three big things. One of them, I could say lots of investors in this space are interested in. The other two, I would say, are specifically people who are worried about the long-term feasibility of oil and gas. That's what you would be looking for. You'd be looking for energy transition and how these companies position themselves for it. Canadian Natural Resources has a completely different strategy. And again, let's talk about some core focus areas here. Massive production growth. The numbers that I saw was they're hoping to increase production by 12% in 2025, thanks in part to acquisitions from Chevron and now Shell, but also from drilling hundreds of new wells. Capital budget is also up with a total of $6.15 billion earmarked, so sort of set aside for capital expenditure in 2025. So that's every acquisition, yes, but it's also every new well. That's every new little bit of infrastructure. That's every new, mile of pipe or square foot of new property that they own that they can now drill or mine on. So lots and lots of growth, lots of money put aside for growth. They're also invested in decarbonizing, but their focus is specifically on carbon capture and specifically on something called the Pathways Alliance. If you're not familiar, it's essentially a network of carbon capture set up here in Alberta, but also beyond and sort of among the big Canadian energy producers. And the idea is that they're trying to specifically target this sector and reduce emissions. So again, we're talking upstream, yeah, but we're also talking upgraders and midstream and downstream. They're just doing everything they can to sort of reduce the carbon footprint of the sector so that we can have potentially a continued growth in production, but also a continued reduction in emissions, which is actually more or less how the industry has played out over the last 10 years. Is that going to happen necessarily? Maybe not. But this is how CNRL, Canadian Natural, is putting themselves in a position to sort of future-proof. They're looking at carbon capture. They're trying to not avoid the asset or divest from the assets specifically, but instead how to change their footprint, the assets themselves. The third core focus I have here is high-grade assets. So they're focusing on long-life oil sands and mines. Now, what does this mean? Basically, their plan is to outlast others. Now, I know this is kind of a sort of surprising thing. I was going to say very surprising, but maybe not, because most of you are probably energy investors. You probably understand that oil and gas is not going away in the next couple of years. But a lot of people who might not be focused on this sector and maybe have uninvestment in Canadian energy or one or two or just looking at it would be thinking, well, hey, isn't there sort of a timeline on Canadian energy, on oil and gas, carbon sort of fuel in general? Is there not like a specific timeline after which these companies are going to be sort of less profitable, less efficient, less in demand, the price is going to drop? My answer to that is probably not, maybe not. I think there's a lot of very interesting ideas out there for sure, but I imagine we're probably still going to need these fuels globally for a long time. Now, can some economies divest completely from fossil fuels? Yes, some can. And with more technology, more and more can. But the problem is that is going to be concentrated in developed countries in places like Europe, maybe East Asia. You're thinking like the Japans and Koreas of the world, maybe here in North America, when we, further utilize nuclear energy or better energy storage or whatever the next breakthrough is. I could totally see those countries being able to reduce their need for fossil fuels. But unfortunately, that only makes up not even a third of the global population. And there are lots of countries growing fast that are still burning coal. So I think actually putting themselves in a position to continue to sort of have peak production for a long, long time. The Canadian oil sands are unique because they have a super, super long time frame that they can continue to get oil out of the ground, in contrast with shale oil in the US that maybe has another 5-10 years until the peak is, and then they're going to probably not be able to gain as much just based on what people have been saying. But also, obviously, the geopolitical questions of lots of other oil producers around the world where it's like, can they continue to operate or not? So I think being in a position where they can focus on the long term is actually really interesting. And again, specifically, I'm thinking shale oil, Permian Basin. I've heard people say 2030 is probably going to be the peak before they start to reduce some of the production on those basins. And so really interesting to think that these guys could outlast that, and all of a sudden we could see their product in higher demand. Lots of speculation there, though. That's just sort of my thought about those two things. So we have one company who's basically moving in one direction. They're trying to plan for the future, and they are trying to make sure they survive the end of oil. And the other company that's trying to be in a position to capitalize on other sources of oil going away and on global demand increasing. Very, very different strategies. So let's talk a little bit about how they've performed. Again, I've got some numbers here. Let's look at Shell first. We're looking at some astronomical total revenues for this company. It says $284 billion here on FinChat. Huge number. It's really a global company here. But growth numbers, slow. This is a giant. We're compounding at 0.8%. Very slow growth in the last 10 years. But that's not necessarily their priority here, right? They're not focused on growth. Instead, they're focused on sustainability. How can they sustain this level? And when you look at it from that perspective, actually the numbers are okay. Profit, gross profit, we're talking a compound growth of 6.25%. EBITDA, we're talking compound growth at almost 11. So Shell is not exactly growing, but they have so much revenue that there is room for efficiency growth to make up great numbers. Now let's flip over to CNQ. The biggest difference here is going to be the total revenue number. We're looking at revenues of what, 35 billion a year for CNQ, but it's growing at almost 7%. So they're a growing company, not necessarily a sustained company, not one that sort of hit their point and are slowly growing. These guys are growing quite quickly for this space. We look at gross profit, we're going to see smaller numbers. Looking at compound growth, 6%. EBITDA growth 4.25%. So they're growing dramatically faster top line, but they're not increasing their profitability quite as much. Let's talk about shareholder performance, because at the end of the day, as shareholders, that's really what we care about, right? Is yes, of course, we care about the company, but we want to see things work out for us. Total return numbers are always my favorite here, particularly with these sort of high dividend payers. Let's look over at Shell. 5-year total return, about 55%, compound growth of 9%. Considering the revenue top line growth we were looking at, this is impressive, right? Their sort of shares are increasing at the same kind of speed as their profitability. So shareholders are looking at that profitability number and willing to pay more. CNQ, whole nother beast. Whole different story. We're looking at 5-year total return, 195%, compound growth of almost 25%. It's 24 in a bit, but still, that's an insane amount. That's an insane compound growth amount, almost 25%. So it shows shareholders are far more bullish in the long-term growth patterns of CNQ versus Shell. So finally, let's talk a little bit about my thoughts. What am I interested in buying? Well, I've got a couple interesting thoughts here. Number one, I do like to see some of the moves out of Shell. I like to see their profitability increase. I like to see them finding different ways to capture growing trends, right? LNG is really interesting to me. I've been bullish on LNG. I've talked about it a couple times here on the channel. I think Canadian LNG is an opportunity. Shell does too. Love to see that from them. But they're so big that it really is in their best interest to try and navigate an uncertain future and hedge their bets. I understand that. I respect that. They're so diversified. They're around the world. We're very focused here in Canada, so we don't see the whole picture, but they really are sort of trying to survive the end of oil. CNQ, on the other hand, is very Canadian focused. It's leveraging the Canadian opportunity, longer term oil production, and it's growing faster. And because of that, and because of its Canadian focus and its room to grow, and because it lines up better with my personal bullish thesis on the Canadian oil and gas industry, they're my pick. They simply are my pick, and it's reflected in my portfolio. I own lots of shares of CNQ. I've been a buyer of shares in the last little while, and I'll continue to be a buyer in the future. And they are simply focusing on what they do best. And there's a lot of room for them to grow. As an operator, they need to do better at some things. I have heard that many times here. As a company, they could grow their profitability a little bit better. Clearly, other companies have been able to. And they are in a position where the short to medium term is incredibly uncertain. And so they need to make sure they are continuing to be as efficient as possible, because that profit is going to be their safety net if things do go wrong. But in the long term, over my time horizon, 10, 20 years, I expect the last kind of 5-year growth numbers, that 200%-ish over 5 years, I think that could be repeated many times if the trends work out the way that I believe they will. And if they don't, I will be happy for a incredibly profitable, very, very fast growing Canadian energy giant. I'm happy to have that in my portfolio. It just fits better what I am trying to do with that specific investment. Now, I'd love to hear from you guys. Let me know in the comments down below. Whose strategy do you like more? Are you sort of on Team Shell? Are you on Team CNQ? Which of these stocks do you own and why? I would love to hear that. Drop a comment down there. I'll leave a pinned comment asking you guys what sort of side you are on. And if you made it this far in the video, you're interested in this kind of stuff, you want to learn more about Canadian investing particularly, we've been talking a lot about the big trends in Canada, the ways that investors could get a little bit of an advantage by investing in Canada. Please do subscribe to the channel. We talk about this stuff every week. And with that being said, I hope I see you in the next video.